Welcome, everyone. My name is Matt Gordillo. I'm a partner and financial advisor with Park Edge Advisors, and this is our monthly market insights. I'm joined by portfolio manager Gavin Gowecki and our chief investment officer and partner Rich Lowry. Hey, guys.
Hey, Matt. Good
Hi,
afternoon.
Matt.
Before we begin, gentlemen, lots going on, but let's just pause a moment for a word from our sponsors, please. Okay. Thanks so much, Gavin. Rich. Wow. Been 30 days since we last talked, and we've all been very, very busy. And so, Gavin, why don't you start us with a recap from where we were last month, and then we'll kind of dive into everything that's going on since then and go from there.
Sure. Most people listening will recall that for the last few installments of Market Insights, there's been a battle between Quad 2 and Quad 3. And that's really reflation versus inflation, but inflation going up in both cases. And what we've come to realize now, the market has switched to first it switched to a Quad 4 regime, which is deflation. And then now we're still, and we've always kind of been leaning to the outcome eventually coming around to potentially the Quad 3 inflation. Since we last spoke, equity markets have put in a full correction, which we called out as like potentially slowing growth. So maybe equities have started to price in a little bit more of that slowing growth, which was probably appropriate. And now I think Rich will touch on this more too. The inflation side of things is really what we still think is a bit maybe, the consensus on inflation might be a little bit too low. And although we think that this month, we just saw today the CPI come in lower than expected, we do see a soft patch for inflation. But the idea being that once we get through the next couple of months, consensus on inflation might be too low, where we would think that inflation should kind of stick and still be, uncomfortably above the Fed's target. So that's, I guess, a pretty good broad update from last time.
And then, Rich, could you tell us why, Quad 3 and Quad 4 are risk off, and maybe anything you want to add to Gavin's update from last month?
Yeah, the only thing I would add to Gavin's comment is in the printed Market Insights that goes out beginning of every month, and in these videos, we've said that the battle between Quad 2 and 3 is likely to resolve in Quad 3. And that looks like that's happening. So, there are two parts of the process. One is to identify the regime that we're in currently. And then the next part is to help prepare for regime change. No regime is going to last forever. So whatever regime we're in, what's the most probable path next? So I would say for the last 4 to 5 months, we've been calling out Quad 2 is likely to give way to Quad 3, and that's happening. And that doesn't include tariffs, immigration, spending, debt issuance, et cetera. The reason Quad 3 is risk off is primarily that growth is slowing. And when growth slows, earnings are going to slow faster. And if you back test, go back in history and say, let's look at all the periods where growth is slowing, inflation is accelerating, you tend to get negative performance. Higher probability that the market goes down and then going up in Quad 3. The other thing is the Fed is constrained. So the Fed reacts with a lag, and each quadrant produces a set of variables that the Fed responds to with a lag. In Quad 3, the feature as it relates to the Fed's reaction function is they're constrained. Inflation is telling them they should not cut. Slowing growth is telling them they should cut. And it's, the problem with having a dual mandate is like hitting 2 targets with 1 arrow. The other problem is both variables employment and inflation are the most lagging of anything out there. So by the time it shows up in one of their targets, it's often too late, and they get mixed signals where one's telling them to cut, the other one is telling them not to cut. And if they're constrained and they do nothing, it means there's that much more of a delay before they turn on the printing press to bail everybody out, like they've, done since 2008.
Very good. Hey, Richard, Gavin, I'm kind of curious, we haven't had any this type of market volatility in over a year. Gavin, you mentioned a correction, which for the listeners, that's a 10% pullback from the highs. And, I guess what I was wondering is, what is it that you think has changed? And, is this just a little steam being blown off because we haven't had volatility in a while, or is this something more policy driven, fear, combination of the above? But just in general, what do you think's going on with this recent pop?
It's obviously the policy side. So there is a economic policy uncertainty index that's gone parabolic. It is almost where it was in the COVID, episode, which is almost where it was in 2008.
Wow.
Totally different environment. The uncertainty then was, you had this crisis and what's going to happen, what's going to be the policy response. Here you have kind of a laid out plan of action, so people know basically what's in play. But they're all big variables. They all have pros and cons to them. And the size, the scope, and the sequence of the implementation is really going to matter. So if tariffs are used as a negotiating tool and they end up never getting enacted, maybe that's good. But tariffs are a tax. You're raising the tax on one kind of economic activity. That's going to hurt growth, no matter how you slice it. The immigration crackdown has the potential to tighten up the labor market. There are 4 million people that are in the labor force that are here illegally, but they go to work every day just like we do. And I don't think anybody is calling for them to be deported. But depending on how they handle the other deportations, some people could self-deport, and that could tighten things up. So everything has a positive outcome to it and a negative. And we don't know what that configuration is going to be. So the range of outcomes widens. And a case in point is, rather than face tariffs, Germany, who's probably the most fiscally, restrained member of the EU, said, well, no thanks. We're going to spend and build out our own military. And what that has done is caused interest rates in Europe to spike higher, which could lead to dollars being repatriated back to Germany. So the scenario would be, we're not going to do what you want. We're not going to play game with the tariffs. They're actually going to try to amend their budget restraint and get $800 billion exemption to build out their own military and infrastructure. If that happens, interest rates are going to stay high in Europe. It'd be hard to think that US rates could decouple from Europe. So that's going to create upward pressure on interest rates here. And it could lead to dollar repatriation back overseas, which would not, and all this is coming to head at the same time. So I would expect volatility to be here, for a while. And, investors either, if they're in a strategy that doesn't adjust the allocation, just be mindful of the fact that volatility is already heightened and is likely to continue. And, obviously we offer strategies where the risk level can change by quite a bit. And that's, Gavin and mine, we have the job of making those adjustments and navigating periods like this.
I was gonna say, Gavin, as a money manager, it's it's weird. When everything was about interest rates, it seemed like good news was bad news because good news in the economy meant the Fed wasn't gonna be able to lower rates anymore. And so now it almost feels, it almost feels like the market's a little bit more back to normal. We're getting volatility in equities. The bond market has been good. Some diversification has helped, and so I was wondering, is this something that you prefer these more types of, kind of standard market environments, or is it all about the process for you anyways?
Well, it's always about the process, but the big difference, to hit on what Rich just said, is really there's something called the VIX, which is the volatility basically of put options, let's just say 30 days out on the S&P 500. Last year, give or take, but ballpark, that was under 20 on the VIX. What we're seeing in recent weeks in this correction is a VIX between 20 and 30. And so that's a different volatility regime. So the correction we saw this year was 8 to 10%. Last year we had 3. By classical traditional definitions, people would say those weren't corrections, but I would actually argue they were, but they were lower volatility. So you could get a 4 to 6% correction. It's just a matter of, with all the uncertainty out there, like Rich just highlighted all the different things, I think the market is just saying that there's all these possibilities. The range of outcomes has increased. We called that out in January as like, this is probably what's going to happen this year. It's just going to be more volatile. And I think that's, we don't really prefer one or over the other because there's a different way to set up a portfolio for each one. And then the one that you really want to watch out for would be, give or take, the VIX over 30, where assets become uninvestable because no one is prepared to hold stocks through those types of violent moves. And so we haven't seen that yet this year. We could, but for now, we know how to read it. And with all this uncertainty, like Rich said, I would say we could very well see that type of environment the rest of the year, at least into the summer.
And to me, it reinforces why we do the regime segmentation the way we do. Range of probable outcomes is as wide as I've ever seen it in my career. I've never seen a period where you have this many very large policy initiatives on the table at the same time. It would be impossible for anybody to predict the outcome of any one policy area, let alone 5 or 6 at the same time. But the way we have the process designed, it's basically the same, regardless of Republican or Democrat, regardless of the policy that anybody is talking about or trying to guess an outcome to. It is, what is the regime that the market is currently in right now? Can you identify that? And then can you prepare for a change into the most probable next regime? And it's just being in alignment with not, where we're looking well beyond stocks and looking at volatility, commodities, currencies, interest rates, swaps, spreads, et cetera, and say, when that constellation of global macro is pricing in a certain regime, that's how we want to be positioned until the regime changes.
Well, I appreciate that feedback, Rich, and I know, I can just tell you two are not thrown off by this volatility, something that was expected, and I think our clients really appreciate that. I know that in our most active strategies, we've been, playing the risk off game in advance of this, and I think the other thing is for those investors who are buy and hold, these are the times that it gets very difficult because of, just like you said, the uncertainty is just so high. We've only got a little bit of a correction, and who knows what's around the corner. So it's just reassuring to know that the active management strategy that we're deploying, I think, for our clients, helps them sleep at night. And so I appreciate that feedback. And any closing comments going forward? I guess we'll have to wait and see, but that was a really good recap, I think, from both of you.
Yeah, not from me. I'm all set.
Okay, keep up the good work, Rich. Gavin, we'll talk to you next month.
All right, see you, Matt.